when you look at CDS, when you're starting to do your due diligence with making an investment in a company, you want to look to see what is the CDS curve, is the 5-year CDS of a company, which is the most liquid part. And most people, when they say CDS, they normally refer to the 5-year CDS spread. How's it acting? How's it behaving? Is it very volatile right now? Is it widening? Is it tightening relative to past performance, relative to where it's been the last 3 months? You want to get an idea of what the credit markets are basically saying about a company. And when you see volatility in a CDS name, it's going to spark some credit traders to look at shorting that name. So as a general view, when you see volatility in CDS spike up, you're going to want to look at that company and say, hey, somebody has some issues with that company out there. Let's take a look to see what those issues might be. If you start to see some volatility in a CDS name, regardless of what name, whether it's the index or whether it's an individual corporate name, first thing you want to do is that volatility limited to just the 5-year point on its credit curve? Is it the fact that there's something going on in the market and people are looking to hedge themselves using CDS? Okay, because that can add some volatility when it's nothing other than just people just buying some portfolio protection. However, if it becomes more sustained weakness in the CDS, high increased volatility that remains increased, you're going to want to start looking at other points along the credit curve. Is the 5-year spread on a CDS now wider than the 10-year? Is the 1-year wider than the 5-year? Is the 3-year wider than the 5-year? When the front end of a CDS credit curve trades at a wider spread than the 5-year point, it normally indicates severe financial distress for that company. It basically says that this company has a high chance of defaulting within the next 12 to 24 months. And if that's the case, you're looking at your equity investment. It may look like a cheap stock price, but what you're actually buying is an option on the survivability of the company.